Okay, we're going to go ahead and move forward and get started with our FYI 2017 webinar series. Welcome, everybody. Thank you for attending. Today's webinar is about foreign bank account reporting or foreign tax reporting, and our presenter today is Michelle Ferreira, who is a lawyer here in San Francisco. And we have a little bit more about her in another slide. So I'll just move on to some how you ask a question. So everybody is in listen-only mode, and if you want to ask a question, you could type it into the GoToWebinar console. We're going to save all the questions for the end, but you can type in your question at any time, and if we will try to answer all the questions at the end. If for some reason we don't get to your question, we will respond via email, and either PALCUS will respond directly or Michelle will respond directly. So either way, you will get your question answered. But this is how you would ask a question during the webinar today. And today's presenter is G. Michelle Freire, and we're actually really blessed to have her. She is one of the premier experts in this topic. So if there's a question she can't answer, then we're not asking the right question, or it's not answerable, or maybe it's not on the right topic. So she has been doing this for a very long time. She's based here in San Francisco. I encourage you to go and visit the website and look at her background, because there isn't anybody better that we could have had as our presenter today. So thank you, Michelle, for being here. Why don't you come in? Welcome to the webinar.
Thank you, Angela. So I appreciate the introduction. I want to thank you all for asking me to give this presentation. When Angela gave me a call and asked if I knew anything about this is a topic that I do on a regular basis. So it's something that I practice very often. We get this the type of advice that I give to my clients. So today I was going to talk about, that would be on the summary slide. I don't know if I'm the person to be sliding the slides, Angela.
Yep, I'll be doing it, so just tell me.
Okay, great. I'll prompt. That sounds great. I'm going to talk about these 4 topics today. One is FBAR, that stands for Foreign Bank Account Reporting. That is how you report your interest in a foreign bank account. We're going to talk all about that, and who's required to file one, and what happens if you don't file one, and how to fix it if you haven't filed one. We're also going to discuss foreign entity reporting requirements. So if you have an interest in a foreign trust or a foreign corporation or a foreign partnership, there's some reporting requirements for that as well. The remedies I already mentioned. So if you fail to file any of these foreign bank account reports or foreign entity reports to the IRS, how you can fix them. And then what to do if you're caught. Sort of how the IRS analyzes somebody who's failed to file one of these. So if you're audited and you haven't filed a foreign bank account report, or an FBAR, as I'm going to refer to it today, or a foreign entity report, I'll talk to you about sort of how the IRS analyzes these cases. I'm going to go to the next slide, Angela. Okay. So first and foremost, we're going to talk about an FBAR. We call them FBARs in my world. That's foreign bank account reports. And a foreign bank account report is required to be filed every year by any U.S. taxpayer that has an interest, an aggregate interest, in bank accounts that exceed $10,000. So that means if you have a bunch of accounts that are $2,000 each, but you have 5 of them, if you hit the $10,000 threshold by $1, then you do have a filing requirement. So it doesn't really matter, collectively what's in them is what matters. If it's in excess of $10,000, then you're required to file an FBAR. A financial account, it does not include a hedge fund or a private equity fund. And there are some specialized savings, bonds, CDs that don't require an FBAR. There's a lot of information on the IRS's website, and obviously you can talk to a tax practitioner about whether your account requires an FBAR. But most of the time, any sort of account that's a savings or a checking or any kind of an account that has liquidity to it, even if it's being traded, usually has a foreign bank account reporting requirement if it's in a foreign country. A U.S. person is defined as either a U.S. citizen or a resident alien who has a green card, and any entities that are created under the laws of U.S. who have foreign bank accounts. Next slide, Angela. There are people who have a financial interest in an account, So that's the person, that's also defined as a person who actually owns the account or has record legal title. I know that there are a lot of cultures where grandparents or parents put bank accounts in foreign countries in the name of their U.S. children, even though it's understood in that culture that the account only belongs to the parents during their lifetime and not to the children until after they pass away. If you are the record owner in the bank as the owner of that bank account, you are required to file an FBAR even though it's not your money. That's true for corporate accounts and partnership accounts and trust accounts if you own more than 50% of those entities, and if you have more than 50% of the voting power in those entities. And these are really specialized rules. Everybody's going to have some really, there are some complex structures out there, and people in my world need to analyze whether somebody has an FBAR filing requirement. So that's who is required to file an FBAR. We're going to go to the next slide, Angela. So people who have either an ownership interest in or a financial interest in an FBAR are required to file FBARs, and if you have signatory authority over a foreign bank account, you are required to file an FBAR as well. A lot of people in the United States run companies that have foreign bank accounts because they have businesses in foreign countries. And if you are an individual that works for a company and you may not own that bank account, but you're somebody that has a signatory authority over the bank account, for example, like in Hong Kong, you are also required to file an FBAR. So as you can imagine, there could be multiple people filing an FBAR for the same account, meaning the entity that owns the bank account or the individuals that own the bank account, those would be people who have a financial interest in that account. And if you're just an employee but you have a signatory authority over the bank account, you have a filing requirement as well. The way that the FBAR form itself is structured is it does designate who owns an account versus who has signatory authority. The form is very, very complicated. I can't remember the number of it. It's on the IRS's website, and your accountant now, most accountants should know what those forms are. They used to be due on June 30th of the following tax year. They were a separate form from your 1040, your personal income tax return, but as of this year, they've changed the due date, and so the due date was now April 15th, when most people's tax returns are due. But if you're on extension and you have a timely filed extension to file your tax return, you now can file your FBAR with your tax return by October 15th. The next slide. Before I get into what the penalties are for failing to file FBARs, I kind of want to talk about sort of how, I know a lot of you are going to wonder, how does the IRS find you if you had a filing requirement and failed to file it? And the way the IRS currently, and the reason that we're hearing a lot more about this issue, and the reason I've known a lot about this issue since 2017, is the IRS has done a lot of investigations of foreign banks in multiple countries, not just in Switzerland, which is where a lot of these investigations started, but now they've expanded them to Asia and to other tax haven jurisdictions, Europe, India. So a lot of foreign banks have been under investigation for aiding U.S. taxpayers to evade tax. And so when there's an investigation of the bank, the IRS will be able to retrieve records from that bank and find out who's banking there and not filing FBARs and paying their taxes in the United States. Another way that the IRS is picking up these cases is there's a new requirement for foreign banks under FATCA. It's F-A-T-C-A, the Foreign Account Taxpayer, I can't remember, it's an acronym. FATCA is now requiring foreign banks who have U.S. taxpayers, so in order for a foreign bank to do business in the United States, it's required to get a Form W-9 completed by all of its U.S. taxpayers. So a lot of the banks in the last year have been sending the U.S. taxpayers this W-9, and if you don't complete it, they're telling you you can't bank there anymore, and that's so that the bank can now continue to do business in the United States. So that information is getting transmitted to the IRS, and they're now going through the FATCA reporting that they receive from the banks in order to discover who's been banking in foreign bank accounts. There are Also, Ben, we're going to talk a little bit at the end about the voluntary disclosure programs that the IRS has. That's under the remedies section. But in those voluntary disclosure programs, there are oftentimes multiple taxpayers who share one bank account. Some of them have come clean to the IRS and reported their foreign bank account, and in that voluntary disclosure, information gets shared about other taxpayers who are not in compliance, and the IRS is picking up those individuals in the voluntary disclosure programs as well. So what are the penalties for failing to report a foreign bank account? Well, there are two, and I know that most of you have probably heard about it. The really bad one is the willful penalty. So if the IRS finds that a taxpayer willfully, and that means intended, to not report their interest in a foreign bank account, the IRS will impose the greater of 50% of the aggregate value of all the bank accounts, or 100%, but in no instance can the IRS impose more than 100% of the foreign bank accounts. So the statute of limitations for the IRS to audit an FBAR penalty is 6 years. So if you haven't filed one, they can go back 6 years. And they can pick up, if they find that somebody is willful, up to 50% of the bank account per year, not to exceed 100% of the bank account. So originally the penalty was a maximum of 50% per year without this 100% threshold. So I'll use an example. If somebody had a $2 million bank account and it was audited for 6 years and the IRS found that they were willful, the IRS could impose up to 50%, which is $1 million for a 6-year period. And what was happening is people were finding themselves liable for $6 million penalty, because it's over 6 years, when they only have $2 million in the bank account. So now the maximum, the worst that can happen is the IRS, in my example, could only get $2 million. They could get up to $2 million from that bank account. So these are really onerous penalties. I have them in my inventory. They're difficult cases to fight, and they're new. I mean, this is sort of a new area of the law in my world. And so sort of the parameters on what makes something willful, we're going to talk about that in the next slides, is what happens. For most people, though, I don't want to freak everybody out here on the phone. Most people, at worst case scenario, have this non-willful penalty that's equal to $10,000 per year, which actually has some defenses. It's called a reasonable cause defense. Reasonable cause means the person didn't really understand the rules and regulations and just made a mistake. And oftentimes my cases, I'm arguing about whether there's reasonable cause and whether there's defenses to the willful penalty. Next slide, Angela.
Yeah, just one quick question. I know we were saving most of them for the end, but for statute of limitations, so does that mean that if somebody, they can't go past 6 years, so let's say somebody hasn't done this reporting for 10 years, the IRS can only go back 6 years? Is that what that means?
Correct.
Okay.
They can only go back 6 years.
Okay.
Yes, that is correct. And that's whether you file or not. So filing doesn't shorten that. So if you filed for the last 6 years, but you had an error on it, on your FBAR, you're missing an account or something, they can audit to 6 years.
Okay.
So, okay.
Okay.
I think I've already talked about the next slide, so let's skip this one, Angela. Obviously, people can read these. I'm also going to not freak anybody out. Criminal offenses, I have not seen a criminal FBAR case in my inventory. They're rare. Most of the time, they're just monetary penalties that we just talked about, the difference between the non-willful versus willful. But these are what can happen to really bad taxpayers, which I doubt anybody on this phone is. People who truly are trying to hide the money from the government, and the IRS is able to prove beyond a reasonable doubt. Criminal is a much higher standard than the willful penalty, which is a civil penalty. Here are the penalties. You can be fined up to $250,000 or spend 5 years in jail. But that's not going to be relevant to anybody on this phone.
Okay.
So, the next slide, the willfulness standard. How does the IRS determine what is willful for purposes of determining whether the penalty should be 50%? It is it's either a knowing, meaning intentional, reckless violation of a known legal duty, and that's a question of fact. And the IRS develops a lot of factual inferences to reach whether they believe somebody was willful. And reckless conduct is defined as a substantial risk of violating a statutory duty. And willful blindness is what I see more commonly argued by the IRS is a person deliberately takes actions to avoid learning about their duty. And the way that comes up is somebody has a foreign bank account. They know that if they ask their accountant or their tax lawyer about whether they have a filing requirement and they just don't ask, it's kind of like don't ask, don't tell, then they won't get the answer that they're required to file it. So that's willful blindness. And on all of these willful cases, the government, meaning the IRS, bears the burden of proving beyond a preponderance of the evidence. The next slide. I want to talk briefly, just so you all are aware, that there are foreign entity reporting requirements. So these are just information returns, not tax returns, that also have their own filing requirements and penalties for failing to include them. So the FBAR that we just talked about, or foreign bank account report, reports an interest in a foreign bank account. It's just an information return. You're providing information to the IRS to let them know that you have bank accounts in excess of $10,000, and if you don't do that, it has certain penalties. Foreign entity reports are reporting that you have an interest in either a foreign trust, and they require a Form 3520 or 3520A. These are really complicated forms. I don't expect you guys to understand them. That's what people like me or like accountants are supposed to determine. But failing to include them, meaning failing to include them with your income tax return, if you do have an interest in a foreign trust, has a penalty. So if you receive a foreign gift and you fail to file a Form 3520A, the penalty can be up, 5% of the gift, or not to exceed 25%. So that's kind of a big penalty. Same thing with the U.S. owner of a foreign trust. Well, a lot of people who live here in the United States have foreign trusts for a lot of reasons. They have property in a foreign country, they have family in a foreign country, or they're from a foreign country. They're supposed to file a 3520 and let them know, let the IRS know that they have assets in this foreign trust. The failing to file the 3520 or the 3520A is a penalty of $10,000 per form. So if you had six trusts and you were required to file 6 3520s, the penalty could be $10,000 per form. And the statute of limitations is different from the FBAR, is unlimited, meaning if you don't include a foreign entity report with your tax return, that's true of corporations and partnerships, it keeps the statute of limitations open on your tax return, unlimited, forever.
Yikes.
So that means the IRS can come back and look at your Schedule C business, which is domestic, if you don't include a 3520. It's a really, really onerous thing. So when in doubt, we usually tell somebody there's no harm in reporting a foreign entity if you don't know, whether you're required to or not. A lot of times we advise people to file them because it starts the ticking of statute of limitations. The next slide, Angela. Just wanted you to be aware that when you have an interest in a foreign corporation or a foreign partnership, that they have their own forms that are similar to the 3520. They're called the 5471 or the Form 8865. They're here in the slides. Failing to include those has a $10,000 per failure, meaning per form, and also an unlimited statute of limitations. The rules on whether you're required to file one of these or not are extremely complex. There are, instructions that go with these forms because it's, as you can imagine, every entity is going to be different, and every person's interest in a foreign entity is going to be different. I would advise everybody on this call to get some advice about whether they need to file one of these forms because they're pretty complex. And I'm not going to go into all the complexities because it's just too much to cover today, Angela.
Okay.
Okay, and really quickly, and then I know we have to turn it over to the questions. These are the factors that the IRS looks at. This is on the next slide, Angela, to determine whether somebody was willful. And no one factor is going to sink your ship. These are all the factors. One of them is the first place the IRS goes is on your Schedule B. That's a Schedule B is where you report your interest in interest and dividends. There's a box there. I don't remember what line it is. It changes every year. That it's on Schedule B that asks if you have an interest in a foreign bank account or a foreign entity, and you're supposed to check that box yes. Most tax preparers software defaults to no. So most people who have an interest in a foreign bank account and have failed to do that, it has been my experience that that box has been checked no. On the tax return itself, it says if you check this box yes, you may have an FBAR filing requirement. And so the IRS has been using that failure for people to check that box yes, as evidence, as one prong of showing willfulness. It's not perfect, but they also look and see what information you provided to your tax preparer. Did you tell your tax return preparer that you had foreign bank accounts, and did they fail to tell you to file an FBAR? Did you get any tax advice at all and find out what your filing requirement was? The amount of unreported income, let's say that you have an interest in foreign bank accounts and you're earning a lot of money on it, and it's also not being reported, meaning the income tax on that and the FBAR, that might be a factor to go towards willfulness. The IRS also looks at how you use the funds that are in the foreign bank account. Did you just inherit this account from your grandmother and it sat there and you never touched it, or did you, I have some clients that packed suitcases worth of, with cash and took it to Switzerland and went, oh, it happens, took it to Switzerland and tried to open up a bank account so that the IRS wouldn't detect that they had an interest in a foreign bank account. So these are factors that they look at. An inherited account might show less willfulness than somebody who took, affirmative steps like the suitcase full of cash to Switzerland to try to, hide the money. They also look at the taxpayer's connection to a foreign jurisdiction. Some people were born in a foreign country. They may do business there. They may have family there. They may spend time there. There's nothing wrong with you having a foreign bank account, but you need to report it. But, a lot of people go through troubles to, open up a foreign bank account just to hide their money. But if that's the only connection to the foreign country, I use Switzerland because that's a perfect example, then that might be a factor towards willfulness versus somebody who, was born in Italy and has family in Italy and spends half the year in Italy. That might lean less towards willfulness. They just legitimately need to have a bank account in Italy. They also look to see if you're filing tax returns and reporting the income in the foreign country. So if you're earning income on the foreign bank account or from the foreign entity, but have failed to report it here in the United States, but you're reporting and paying tax on it in the foreign country, that seems to go against willfulness. And I think I have two more factors, or some more factors on the other slide, Angela. These are more relevant factors. The business reasons for maintaining it. Some people do business legitimately in Hong Kong, and they need to have a bank account in Hong Kong. They also look at the taxpayer's business and tax sophistication. Is this person educated, uneducated? Are they a business person? Do they know about foreign reporting? Whenever these audits happen, there's a lot of inquiry that goes into what the taxpayer's knowledge was. They also look to see what kind of information they received from the foreign banks telling them what their obligations were here in the United States. I use the FATCA reporting, which I think almost all banks are now following. You're getting that information that you need to fill out the W-9. Maybe you should know that you need to get some advice and report your foreign bank accounts. Some people set up foreign entities or multiple entities in order to conceal the ownership, so the bank account is in the name of a foreign entity rather than an individual, and that's kind of a factor that leads towards willfulness. But then there are people who legitimately have bank accounts in the name of an entity because they do business in that name of the entity in the foreign account. So these are just factual inquiries that the IRS looks at when setting this, when determining willfulness. Some bank accounts, particularly the ones in Switzerland, actually allowed taxpayers to remove money from those bank accounts by using what's called a debit card, like your ATM card. That was done so that there wouldn't be transfers from Switzerland to, Wells Fargo, for example. That's kind of a factor that goes towards willfulness because it's done with the intent to conceal. That's the presumption. And finally, there's two more factors on the next page. Whether the taxpayer says, don't send my mail about my Swiss bank account to me in the United States, just hold all my bank statements and I'll come look at the bank or I'll look at it online, but don't mail me any information about that. A lot of these foreign bank accounts will charge an extra fee per month to not mail you statements, And the IRS takes that as an intent to conceal because you're not getting the mail here that would be discoverable by the IRS. And then I just put other factors. There are just lots of other factors the IRS looks at to determine willfulness. So this whole list, it's not exclusive, but basically when somebody has a foreign bank account, each case is looked at as a sort of a factual inquiry to determine whether somebody is bad and should probably be subject to the willful penalty or whether they should be subject to the negligence penalty. And in my world, I spend most of my day trying to prove these facts are not true in my cases. I know that I need to give time for questions, but I'm just going to talk a little bit about the remedies, Angela. There are some voluntary disclosure programs. I'm sure this was one of the questions you had, Angela. And there are three different ones. There's the Offshore Voluntary Disclosure Program, the Streamlined Filing Procedure Program, the Streamlined Offshore Filing Procedures, and the Delinquent Information Returns. Each of them are basically where you can come forward to the IRS in exchange and pay a penalty. Some are worse penalties than others. And, basically ask for forgiveness for the prior years. So I'll start with the Offshore Voluntary Disclosure Program. The Offshore Voluntary Disclosure Program, if you're not currently under audit and the IRS doesn't know about you or your company, your entity, then you can ask to be admitted into the Voluntary Disclosure Program. You have to agree to file 8 years worth of tax returns, and tax returns would include paying all the unreported offshore income, any amount that the foreign bank account may have earned over 8 years, or anything that you didn't report for your foreign entities. That all has to be reported on your income tax return, and agree to pay the tax on the unreported income, foreign income, and a 20% negligence penalty. You also have to agree to file 8 years worth of information returns. These are the returns I just discussed today, which is the FBAR or the entity returns, the 3520 or the 5471, and pay a one-time offshore penalty that is 27.5% of the taxpayer's total offshore assets. So if and that's not just the bank accounts. So if the bank accounts and the taxpayer's assets, that's their real estate, their works of art or whatever, that's located in a foreign country is $10 million. Let's say it adds up to $10 million. In order to not be prosecuted criminally, you have to agree to pay $2.75 million, 27.5% on the $10 million. So that is normally, in my world, that's normally designed for people who we believe have criminal exposure. Obviously, they want to pay that penalty instead of going to jail. It's not really intended for taxpayers who just negligently failed to report the offshore income. And a determination as to whether somebody's bad or negligent is really something that should be done by somebody like me or somebody familiar with the IRS's auditing of these cases. But the next level is the Streamlined Offshore Filing Procedures. That's the Streamlined program. That program has a 5% penalty as opposed to 27.5% on the taxpayer's offshore accounts. So using my example, they would pay 5% of the $10 million rather than 27.5%. They'd file 3 years worth of income tax returns instead of 8, and they'd file 6 years worth of FBARs and pay this one-time 5% penalty. That's if you and your advisor determine that you qualify for that program, because you have to come forward and reveal yourself and file tax returns. And so you want to be absolutely certain that before you enter into the Streamline program that you truly are negligent in the IRS's eyes in order to qualify for that 5% penalty. There's also a Streamlined Offshore program that's designed for taxpayers that live abroad, and they have to reside outside of the United States more than 330 days in the last 3 tax years in order to qualify for that program. That program has a 0 penalty. And that's just an effort to get people who are not in this country into compliance. And again, file 3 years worth of tax returns, 6 years worth of FBARs, but the penalty is 0. And then the Delinquent Information Returns is if you have just failed to file these information returns, the FBAR, the 3520, or the 5471, but you owe no income tax, meaning you don't have any unreported income, meaning interest, dividend, income on any of these assets, then you can just come into and file these tax returns with a reasonable cause statement, and the IRS won't necessarily waive the penalty, but they might. So any of these programs are ways to clean them up. They're obviously very different very different programs with very different consequences. And I always tell accountants and laypersons before making a determination which one of these programs they qualify for, that they should get some legal advice on their specific situation to determine which one might be applicable. I think I talked really fast.
No, you covered so much important information, because I was thinking especially in the areas of if you're like a co-signer on an account, or you're on the record, even if it's not your money, you're still required to report. And I think a lot of children or grandchildren of people who have accounts over there or property or whatever, that's the case, and they probably have no idea that that's a requirement. So I think this is really, really important information. For everybody on the line, if you go to the handouts section of the GoToMeeting console, this presentation is downloadable as a PDF, and so you can go ahead and do that. And here I would also encourage you to read Michelle's background, because she is so very knowledgeable. And before we get to the questions, I just want to put this disclaimer up so everybody can see that. And also, when we get to the questions, if the question is going to be about what the Portuguese government will do, Michelle cannot answer that. She can only talk about what the U.S. government will do and what the IRS will do. So if you have questions about what the Portuguese government will do, you'll have to find a tax attorney in Portugal to answer those questions. Anything else before we get to the questions, Michelle?
No, I think that's it. It is a very, very, very quick overview. There's a lot of information about these programs on the IRS's website. You can Google this. I have found, though, when I suggest people do that, they freak themselves out. And so I don't want you to read about this and freak yourself out. There are people who know a lot about this and who can help you. Each case is very, 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 unique. Everybody's got unique facts as to why they did or did not report their foreign bank account or foreign entity. And so that should be evaluated with somebody who's knowledgeable about what the IRS might do before you get advice on how to fix it.
That's a really good point. Okay, so we do have a couple questions here, and I think the first one is in regards to the 10K penalty in one of the first slides that we talked about. So let me kind of go back up to this. Is it this slide? No, it's
the non-willful penalty. Just F1 penalties.
There we go. So is that dictated by what the dollar-euro conversion rate of the account is in euros, or is it 10,000 US dollars?
Okay, no, it's 10,000 US dollars. So, so it doesn't matter what's in the account. You could have an account that had 10,000. Remember, you only have a filing requirement if you had $10,001 or more. So if you had $10,000 total in your account, then you don't have a filing requirement. So let's say somebody had $15,000 in a bank account and they failed to file an FBAR, and the IRS imposed the penalty. The penalty would be 10,000 US dollars. There are defenses to the penalty. That's the reasonable cause. I would argue against some of the, argue some of those factors in the taxpayer's favor as to why there was a failure, but the failure can be $10,000 per year. So using my example with $15,000 account, and it was a 6-year period, if the IRS decided to impose a non-willful penalty, they could be subject to $60,000, one for each year, because they can only go back 6 years. Did you follow that, Angela?
Yeah. Wow. That's that's a big penalty for an account that's fairly small, right? I mean.
That's right.
Yeah.
But if the account was $100,000, the penalty is still $10,000.
Oh, I see. Okay. Okay.
So, the IRS does take into consideration the size of the account. It shouldn't matter, but it does. It doesn't make sense for the IRS to impose a $60,000 penalty on a $15,000 account, and there are, there's opportunity for somebody like me to maybe get that lowered.
Mm-hmm.
But I just tell you that technically, it could be $10,000 per year.
Got it. But there is some discretion if you're right, using a lawyer like yourself to argue reasonable cause or non-willful reasonable cause, that kind of thing.
That's right.
Okay. And this next question is actually in regards to reasonable cause. Can reasonable cause include ignorance to the penalty? So if somebody just had no idea, and I think maybe you did list that as one of the items, but there's another question about that.
Yeah. Well, as you can imagine, most of my cases are just ignorance of the law. And the IRS hasn't been, in my experience, that sympathetic, which to me, I think that's wholly unfair. That's particularly true because it says on your tax return, on your Schedule B, that if you have a foreign bank account, it's a yes or no question, and you check no. If you check yes, it says you need to file the TD 90.2.1, which is the FBAR form. So they aren't very sympathetic because it's every taxpayer's duty to read their tax return and understand. Now, Angela, you and I both know that a lot of people don't read their tax returns and they don't understand it.
Right.
That's why we hire an accountant. So when you look at ignorance of the law, they also look to, did you inform your accountant that you had a foreign bank account? A lot of, until recently, and I say like in the last 6 years or 5 years, accountants were not asking their clients if they had interest in foreign bank accounts because they just, a lot of accountants were unaware of this. So I have a better argument for an accountant that was unaware of the FBAR filing requirement to show ignorance than a taxpayer who claims ignorance but didn't inform their accountant. So these are what the IRS looks at, and they will interview when they're trying to evaluate this penalty. They will interview not only the taxpayer and what they knew, but they also ask the accountant. And accountants, my experience with accountants is they have a tax organizer that they send. Most of them do, not all of them, that they send to their clients each year that you fill out or don't. Some people don't fill that out, but one of the questions in almost all accountants' tax organizers is, do you have any interest in foreign bank accounts or foreign entities? And so if you don't tell your accountant that, meaning you don't complete the form or you don't give that information, it's going to be really hard to claim ignorance. I'm not saying it's impossible, but it's hard.
Got it. Okay. Another question about, let me get to the slide. It's about the trust, this one here. So can you define entity? Is that just a business, or is that a trust that a family might have? Parents set up for their children.
These rules are really, so there's entity is, on this slide, is just dealing with trust. And remember, the rules for what is a trust in different countries is different than what's a trust in the United States. So I can't define what a trust is in Mexico versus a trust in Italy.
Got it.
Or Portugal. But if it is a trust in that country, and that's something that we could figure out. I mean, that's an answer I can answer. If that entity is considered a trust in Italy, for example, and you are a U.S. taxpayer that is a beneficiary of it or a grantor of it, then you most likely will have this Form 3520 filing requirement. But the laws on what determines what's a trust are determined under the local law of the foreign country. But there are also other entities. There's partnerships, there's corporations, there's associations. There are a lot of really interesting companies in Asia, for example, that don't really meet our U.S. requirements. But for the most part, they're either going to be a trust or a partnership or a corporation and have one of these filing requirements. So it's going to be one of these forms, 3520, the 88, what is it, the 8886, right? Or a 5471. So, but on which one is which, that's a whole long discussion, and we need to look at the facts of somebody's case and see what the filing requirement is before we report it to the United States. Okay.
Another question is in regards to the offshore voluntary disclosure program. You were explaining that if you participate in that first one, you agree to pay tax on the income. Is that correct? That
you actually pay tax on the income in all of the programs, or in the first two programs, the offshore voluntary. So the unreported income. It's just the difference between the two is Usually the offshore voluntary disclosure program is intended for, if I have somebody come to me and I determine that they probably have some criminal exposure, I'm probably, I mean, that's the discussion I need to have very privately with them. I'm probably going to recommend that they go into the offshore voluntary disclosure program, but they have to file for a longer period, it's 8 years, and pay income tax for 8 years, but they also have to pay, and a 20% penalty on the income tax. And then they also have to pay a 27.5% offshore penalty on all their offshore assets, on the value of all their offshore assets. In the streamlined program, the domestic one, if somebody is less willful or less culpable, they have to file only 3 years worth of income tax returns and pay the tax as well, and a 20% negligence penalty on the tax. But the offshore penalty is 5% rather than 27.5%. And it's only on 6 years, not 8.
Okay. So
complicated.
Yeah. So what about a situation if someone has, let's say, a pension in Portugal that they are paying taxes on in Portugal? Would they also get taxed by the U.S. on that pension? Because I believe there's a tax treaty in place where you don't have to pay there's no dual taxation on the same income. So what about that kind of a situation where the person has already paid taxes in Portugal on that income, but they participate in this offshore voluntary or one of these programs, and then so what would be the tax that they agree to pay if they've already, am I making my question clear? I don't know if that's.
Yeah, you are.
Okay.
Now, I'm not going to get it. Foreign pensions are a little bit different because it's kind of questionable whether they need to be reported on an FBAR or not. It depends on the pension. Okay. But let's assume this one needed to be reported. Then let's just pick something simpler. Let's pick an entity like a corporation that had income that wasn't reported here in the United States, but they paid tax in Portugal, using your example. If they pay tax on that entity, whether it's the pension or the corporation in another country, you get the foreign tax credit to offset some, not necessarily all, it's not usually dollar for dollar, the U.S. income tax. But and a lot of people have assumed, well, I was paying tax in Portugal, and the net is I don't really owe anything in the United States. Well, it doesn't work that way. You have to report the whole income because the U.S. taxpayers are taxed on their worldwide income. You have to report all of it and then take the credit, which is kind of a deduction off of the taxes you paid in another country, depending on that country's treaty. That's so in your example, even though they may have paid the full amount of tax in Portugal, they haven't reported it in the IRS's eyes in the United States until they report it and take the offset for the foreign tax credit. Okay.
And depending on what the treaty says, it could be dollar for dollar, or it could be just a portion.
It changes. It depends on the country.
Right.
It depends on the asset.
Right.
Yeah, okay. That's a complex question. But in concept, you report it and you get a credit for the foreign tax credit. How that works out, that's math, and it depends on the country, and it depends on the asset or the type of income, ordinary income versus capital gain. It's all not that simple.
Right. So I think we need to go dig up that treaty and figure out what it says and the details
of that. I don't recommend anybody be digging it up without some, an accountant to help them with stuff like that.
Right. Okay. Well, those are all the questions that we have for now, but this has been so incredibly helpful. I hope that our listeners feel the same. I think they do. And I know that as we will be, this is being recorded, and so we will be uploading it to YouTube, posting it on our website and on Facebook, so everybody can share it with friends and family, because I'm certain that we all know somebody who is in a situation like this, and it's really good information to have. So thank you again, Michelle. This is so helpful.
Oh, good. I'm glad it was helpful, and it was what you were looking. I hope it was what you were looking for.
No, it was perfect. It was exactly what we were looking for. And I would encourage, if anybody has existing or more questions, or you feel like you need to have a conversation with a tax attorney, feel free to reach out to Michelle directly. Her contact information is in the handout, which is this presentation deck. Yeah, just start that process of becoming even more educated about your specific situation and go from there. So As I mentioned, all webinars are archived, both on our website and on YouTube. There is a PDF of the presentation you could download directly here from the GoToWebinar console, but we'll also post that to our website and to Facebook. If anybody on this call or you would like to sponsor the webinar, or you know somebody that would like to sponsor the webinar, these are free to the community and the presenting organization. And we need support from the community to keep this resource free to the community. And it's really affordable. We're not talking thousands of dollars here, just a couple $100 in exchange for getting exposure to thousands of people, because our webinars have reached more than 10,000 people at this point. Because they are posted online and people watch them over and over again. So we continue to gain viewership of our webinars, even a year plus after we've done them. So just reach out to us at PALCUS@palcus.org if you are interested in sponsoring a webinar. And with that, we thank you for attending. Have a wonderful day. And thank you again, Michelle. Really awesome.
Thank you.
So glad
Thanks
we were able
for
to
including me, Angela. Yeah.
This has been great. All right. Thanks, everybody. That's a wrap.
All right.
Goodbye.
Thanks, Angela. Bye-bye.
Bye-bye.